In this presentation, we will add new accounts and their related opening balances to the chart of accounts within QuickBooks Pro 2019. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in QuickBooks Pro, the home page. We currently have the open windows open. The open windows can be opened by going to the View tab and Open Windows List. Our goal here is to add some more accounts. So we first, one, know how to add accounts, and two, we're going to add accounts that have an opening balance, accounts that we need to put on the system, accounts that we need on the financial statements before we start entering data. So in order to get an idea of that, let's go to our balance sheet first to get an idea of our goals and objectives. So we're going to go to the reports up top. We're going to go down to the company and financial. We're going to find that financial statement, that most important of the financials, or one of the two most important, the balance sheet down here. We're going to select the balance sheet. I'm going to make the date as of 12/31/19. That's the end of the time period for which we will be entering data. We haven't entered any data for the current time period, but the beginning data as of so far, as of now, as of so far. So if we look through this, we've got this information we've entered so far. Now we might first now be saying, hey, we have some more information that we still have. We have possibly a checking account here that has some money in it before we start new operations. We have to put that on the books somehow. We might have equipment or something like that that we currently have that's not on the books here. How do we get that stuff on the books? Well, we can set up an account for it or add that information at the beginning balance. Again, the proper way to do this would probably be to set up the accounts and do journal entries, because that would properly set everything up. But the goal of QuickBooks, the starter setup program, is to not have to know debits and credits, not have to do journal entries, and just do the one side of the transaction, and then QuickBooks will force it to work. And that is the reason that we're going to enter all this data prior to the date we're working on. Meaning we're going to work in 2019, we're going to enter this data in 2018. And then QuickBooks will kind of force it to work by entering some other side of the transaction. And that'll be okay. It'll be messy in the setup process, but it should all roll out and be okay in terms of the current date that we are going to be working on. So that's what we're going to do now. We're going to go to the chart of accounts. We're going to add some more accounts that we're going to use. Our goal here is not to add every account that we're going to use. We could do that, but we don't really need to, because one, the chart of accounts has been set up, a fundamental one, with us setting up the company, and two, we can easily set up new accounts as we add new data. As we make expenses, as we pay bills, we might decide, hey, I need another account for that. I want a different account, and we could set that up as we go on the fly, as they say. We can set it up as we enter the data into the system. So we don't need to set up all accounts. Our primary goal here is to set up those accounts that have the beginning balances in them, so that our current balance, our beginning balance, is okay. Any account that's not in the system that, as of now, we don't necessarily have to add it yet. Now again, if we want a very structured system and we have other people using our system, then we probably want to put all the accounts in there so that other people don't put random accounts in there. We'd like to say, hey, use the accounts that are there. Don't just create new accounts. But if we're starting a new company, then it's pretty common for us in the first month of operations to just add accounts as we start entering data. So that's not really our primary goal here. Our primary goal is to get the beginning balances in place with the accounts we're adding. Okay, so to do this, we're going to go to lists. We could, by the way, go to lists a couple different ways. We can go to the home tab and we go to lists over here. But I like to go to the drop downs to get to lists. So our major list, because the drop downs you can go to from anywhere. That's why I use them. But you can go to the lists up top, and we're going to go to the chart of accounts, our major list. So that's our biggest and most important list. Now remember that the chart of accounts is in order, not by account numbers, not by name or alphabetical order, but by account type. Not by account type in terms of alphabetical order, but by the accounting equation. So it's basically assets, and then liabilities, then equity, then income, then expenses. Has to be in that order. Even if we add account numbers, it's not going to override the ordering by type, because that's what has to happen. So within that type, note we have then more specifics. We have all these are assets. They're just different types of assets. And that's in order by liquidity. So we would have cash first, and then accounts receivable, and then other current assets, then fixed assets, then other assets, and then liabilities, which are broken out into current liabilities, or accounts payable, the most current liability, I guess, accounts payable, and then current liabilities. And you might ask, well, why does it do that? Because if you look at the financial statements, all we have is current liabilities, and we, for example, assets. All we have is our current assets and property, plant, and equipment, and other assets possibly. Why does it break out accounts receivable? That's not broken out on the financial statements. Well, that's because the QuickBooks system needs to know accounts receivable accounts as a separate thing, because QuickBooks will make us track customers to it. So we have to break that out separately. And so QuickBooks has kind of its reasons. The fixed asset accounts have possibly depreciation related to it, which may be a reason why we could break out the fixed assets, but those are going to be broken out on the financials anyways. The accounts payable is the same way. It's a current liability, but QuickBooks needs to break it out because it's going to force us to add a vendor. It's not going to let us post anything to payable unless we have a vendor, because it needs to have that supporting ledger to it. So that in order for it to make us do that, to give us that check, that's a good thing so that we don't mess it up, then it has to have a separate account. The other current liabilities then don't have that. And then we have the equity accounts, and then the income or revenue accounts. They call them income accounts, same thing, income, revenue. And then expenses, cost of goods sold being the most important. So when we add accounts, what we need to know then is not just the account name, we need to know the account type. That's going to be the important thing, so that we put it in the correct place within the chart of accounts. If we don't, then we're just going to have stuff like if I accidentally put the inventory in as an expense down here, well then it would kind of mess up the way we enter information, because it would roll the expense out. So we just need to make sure that we're getting the correct account type. Now the first one we're going to add is going to be the checking account. It's going to be our most important account. We're going to add the checking account. To add an account, we can go to the bottom down here. We can go to account, which is the drop up, and we're going to go to new. So we're going to go new. Now here's our most normal accounts that we'll have here. And if they're not listed here, then we can go to the other and we get some more options here. We're going to go to our bank account. So this is going to be bank. It has to be listed as the bank because, again, the bank has special needs for QuickBooks. Banks have special needs, bank accounts. So QuickBooks needs to know it's a bank account, not just a current asset account. So we're going to say it's the bank account, and then we're going to go continue. And so we're setting up the bank account, and I'm just going to call it the checking account. I'll just call it checking. Now, if we have multiple checking accounts, we may want to put the name of the bank. We may want to even put the last 4 digits of the bank number, just to identify one bank account versus another. The last 4 digits are often the unique numbers. So you may want to do something like that. But we're just going to say this is our only checking account, so we're just going to keep it that. We don't need a description because that's not necessary. It's pretty self-explanatory. Bank account number we could add. I'm not going to add a bank account number. Routing number we could add. And again, these would be necessary with certain types of transactions. If we're doing electronic transactions, that would be useful. If not, then it's not really adding much to our information. Tax line mapping. This could be useful. QuickBooks will help us basically, especially if we're using software that's also used by Intuit. So if like TurboTax or something that is made by the same company, then we may be able to link QuickBooks over and have it help us to make the tax preparation. So that's a bit of a tricky process that, that could work, but it's a little tricky too. Normally, oftentimes, if we don't set that up, it's okay typically, because if we're going to have an outside person or go to an accountant to do the taxes, then we'll print the tax forms, the balance sheet, the profit and loss, and that's what will be used by the tax preparer in order to fill out the documentation. So the bottom line is, if you can do this, great. If not, it's okay, right? If you could set that up, that's great. If it's not a mandatory field. Then we're going to go to the enter opening balance here. This is going to be the major thing that we want, because we have a checking account that's already set up, it's already got money in it, and that's what we need to set up in the system here. So I'm going to say opening balance. And we're going to say we currently have 25,000 in the beginning balance. So this is going to be the beginning balance we need to have in there, and it's going to be very useful to do that because it'll help us with the the reconciliation, the bank reconciliations. And we'll talk about that later. But we're going to need to get, most of the time when we set up a new company, oftentimes the checking account is already set up, and we're going to have to basically set that up in the system. And so we want to do that here. Once again, we're going to do that as of the first day prior to the date we're going to be working on. We're going to be working in 2019. We're going to put this in the system as of 12/31/2018. 12/31/18. 12/31/2018 once you hit tab. And so that's what we're going to put it in there as of, so that all the messy stuff QuickBooks got to do to make this work, because we only have one side of the journal entry here. QuickBooks is going to make the other side work. And we'll view that. After we enter these balances, we'll see what QuickBooks is doing. But it should be correct as of the date we start entering data, which is January 1st, 2019. So I'm going to say OK. And that's going to be the checking account. Now we could hit save and close or save and new. We will be making a new one, but I'm going to hit save and close first just to practice going into where we would go to add new accounts. So I'm going to say save and close. And then it's going to save and close, give us this, and QuickBooks is telling us about some features, and oftentimes QuickBooks will do this, especially if we're thinking about payroll or some other features that's talking about the bank feeds feature. We're not going to set up the bank feeds at this time, so I'm going to close this out. Okay, and then we're going to go to another account, so we're going to go to the accounts at the bottom. We're going to add we're going to go to new account once again. And this time we're going to say, hey, we have a credit card. We owe some on the business credit card. We need that on the books. So I'm going to say that's not a current liability, but we're going to make it specific. It is, a current liability, but we're going to make it specific and call it credit card, because credit cards have special needs. We could track the credit card separately, because it's a little tricky. It can be a little tricky to track that credit card, because if we're not paying off the balance each time, we should be recording the liability, and we need to record that liability where we should. Okay, so we're going to say continue, and we're going to set up the credit card, and I'm just going to call it a Visa. So it's a Visa credit card. It's going to be the account name. We can call it Visa or Visa credit card. It's going to be in the liabilities section. Don't need a description. I'm not going to put the credit card number or anything. We could. That might give us more detail if we want to put the credit card number even in the description here. So when we see the chart of accounts, it shows up. That could be useful if we have multiple different credit cards. Again, I would use the last 4 digits or something like that to kind of refer or distinguish accounts. That's often something we could do in different settings if we need to distinguish different checking accounts or credit card accounts. Then again, I'm not going to assign a mapping here. What I want is to enter that beginning balance for the credit card. So I'm going to enter the beginning balances. And we're going to say that we owe a nice even 1,000 to the credit card, which is unlikely that it would be nice and even like that, but this is an example problem, and we're going to say that it is in there as of 12/31/18, the day before we're going to start entering data, which will be the 2019 year. So I'm going to say OK, and that'll be that item. And so we're going to say this time, let's say save and new. So save and new will take us to the next item. This time we're going to say that we have a loan. We took a loan out from the bank, and we have a loan that we need to pay back. So in order to set that up, now note it took us here, and it didn't take us to that first screen we often see. It just took us to this kind of the second screen. And so we don't see the account type, but it's in the drop down here where it says account type, and it's credit card right now. We don't want the credit card because the loan isn't a credit card. What we want to put on the books now is we're saying there's a loan. We owe someone money. We took out a loan possibly from the bank. It's a long-term loan. We owe it back, let's say, over a year's time period. So we got to put that on the books. We got to put the fact that we owe the bank money. So I'm going to say I want to see that on the liability. So I'm going to say it's not a credit card. It's not a current liability, because that would be, I shouldn't have selected it, but that would be if we owe it within a year. So if we owe the loan back in some period over a year, then it would be called a long-term liability. That's what we're going to select, long-term liability. And I'm just going to call that a loan payable. So we're going to call it a loan payable. Again, no description, no sub-account. If we had a sub-account, that basically means like if we had related accounts. So let's say we had multiple loans, we might call it loans and then have sub-accounts that would be related to the master account of loans. So some people really like sub-accounts, others I think it could get a little messy. You got to make sure that when you're using the sub accounts, you know exactly how you're doing this. The sub accounts are nice because you can print reports easily, meaning I can print reports that will have the sub accounts either broken out to show detail, or we can condense the sub accounts and demonstrate reports that are more condensed for readers that don't want to see the detail. So that can be useful. But we're going to just enter the straight accounts. It's going to be description, no description. I'm not going to put any account number. Again, not assigning a tax. What we want is that beginning balance. So we're going to enter the opening balance here. And we're going to say that we have a loan of $22,000, and we're going to put that once again as of 12/31/18, the day before. That's December 31st, 2018. The day before, we're going to start entering data. So again, we're just telling the system, do whatever you got to do. I know I have a loan, put that on the books. QuickBooks is going to have to put something else somewhere, and so it's going to do it for us. And just do whatever you got to do. QuickBooks will take a look at what it does. But for now, we're just going to keep that. We'll say OK. Now I'm going to say save and close. Now it also might be possible that we have beginning balances that didn't show up on the balance sheet. So if we go to the balance sheet over here in the open windows, we're going to say, I have some things that aren't on the balance sheet but already have an account listed. Why aren't they showing on the balance sheet? Because the balance sheet doesn't show accounts with 0 balances in it. So if, for example, we're going to set up a furniture and equipment account here, which is property, plant, and equipment. It's not on the balance sheet, so we're going to say, okay, I need to add that number. I have furniture and equipment. I need to add it here. So we're going to go to the chart of accounts, and we're going to say, well, I don't need to add a new account because the furniture and equipment is right there already. So we're going to use the account that is there. All I need to do is add the beginning balance. It didn't show up on the balance sheet. It wasn't there because it has a 0 in it. Once we add a balance to it, then it will show up on the balance sheet. Now, we could edit this by selecting the drop up and going to edit account, or I believe you could just right click on it and edit it. If you double click on it, it's going to go to a register. You don't want to do that. That's not what we want. At least you can do that if you want to do that, but I'm going to right click on it and we're going to go to edit the account. Edit the account. Okay, so now there it is. So it's already set up. The only thing we need to do is add that opening balance. That's what we want. So we're gonna add the opening balance here. We're gonna say that it is 75,000 of equipment, of furniture and equipment. We have a nice place. It's a really nice couch. Now, so that could be equipment and furniture. And again, if we want to group it a little bit differently than QuickBooks says, we can obviously change the name here to other types of property and equipment, possibly breaking out equipment versus furniture. So we're going to say that. So then we're going to say it's as of 12/31/18. So again, the day before the time period in which we'll be entering data. So we're going to say OK. That one is set up. Another one's set up, and save and close on that one. So we'll save and close that. Okay, so let's take a look at what has happened so far. You can see that all these accounts that we have entered data for, they're showing the beginning balances here. So we kind of have a bit of a trial balance here, but we don't see the debits and credits. We can't see that we're in balance. And we know that the income statement accounts are not going to basically show anything because they're temporary. You'll note that only the balances are shown for the permanent accounts, the balance sheet accounts. What we're going to do now is we'll try to figure out what QuickBooks did to do this, because remember, we only entered 1/2 of the journal entry. We told QuickBooks, hey, I want 75,000 there. There's got to be 75,000 somewhere else, because that's what the double entry accounting system does. So QuickBooks must have done something somewhere else to do that. We said, hey, we need 15,000 there. QuickBooks must have put 15,000 somewhere else, because that's how the double entry accounting system works. Same with here, here, and here. So let's go to the balance sheet and see if we can figure out what QuickBooks has done, figure out if it's okay for QuickBooks to have done so, and then think about just what it did and why. So we're going to go to the balance sheet here. So the balance sheet now, as of 12/31/19, the end of the year that we will be working in, we entered the data as of 12/31/18 into the system, the prior period, the prior year. So the checking account was something we set up. So if I double click on the checking account, we're going to say, and I'm going to go back. I zoomed into it by double clicking on it. I'm going to go back to 2018 and we'll say, there it is. Okay, there's what it did. So if I double click on this, so there's the 25,000 we added. I'm going to double click on that. And it doesn't take me to the account screen where we added the opening balance. It takes me to a deposit screen. Why? Because the deposit screen is what QuickBooks uses. So when we put it in the opening balance screen, QuickBooks said, well, it must be a deposit. You must have deposited something at some point. And so it uses this form to do that. So the deposit form is how you increase the checking account in QuickBooks. So we didn't make a deposit for $25,000. We made multiple deposits and draws prior to this time period. But that's okay because we want to just force it to be correct, the balance to be correct as of now. If we got to go back to any prior data, then we go back to our prior books. We want to make it right as of the day here and go forward. So this looks good. We're going to say, okay, so that's good. Notice it took the other side to opening balance equity. Okay, so that's the other side that it went to. So we'll take a look at that. So I'm closing this out. I'm going to close this back out. So what did it do to the other side? It just said that we put it down here to opening balance equity. So let's see if it's there. Here's opening balance equity. What is that? I don't know. That's kind of a made up account. That's an account QuickBooks makes up because it's just forcing us to work. We're going to have to do something with that account. If someone asks us about that account, we're going to have to explain ourselves because it's not a normal account. So what we'll do is we'll deal with that. But for now, let's just see what QuickBooks did. We'll say, let's double click on that. And we're going to change the date once again to 2018 so we can see the activity. And yeah, there it is. There's the $25,000 to the checking account. So the journal entry it did was increase the checking account and then put the other side into this opening balance equity. Okay, so we'll have to deal with that. So, and that's okay because it's in equity. That's what we would expect it to get to at some point. But the opening balance account is kind of a funny account. It's kind of telling us, hey, this is what we did by putting it into this account that's not really on financial statements. It's a made up QuickBooks account, basically. Okay, so I'm going to close this back out. And then the other thing we did something too is we did this before. Inventory we did before. Furniture, we put that on the books. So we put $75,000 of furniture. Let's double click on that. It shows up here on the balance sheet. That's good. That's what we wanted. How did it do that? Well, let's zoom in on that. Change the date. I'm going to make it as of the last year and see the activity. So there's the activity. And if we look at it, if I double click on that, it's a journal entry. So why is it a journal entry? So you can tell it's a journal entry. We're in the general journal now. It doesn't go back again to that screen where we would think it went because that's where we input it. It goes here. Why? Because when we enter data, when we pay for equipment, there's no form that usually is used to do that. So QuickBooks couldn't really, it's not a normal transaction for us to buy property, plant, and equipment. It doesn't happen every day. We only buy equipment every once in a while. So there's no like documentation like an invoice or whatnot that would a deposit sheet or something. There's no driving form for it because there's only driving forms for things that happen typically on a daily basis. So QuickBooks had to use a journal entry to do this. If you double click on this little journal entry here, we'll double click on this. This is like the default. I'm going to close this out. This is like the default that happens if there's no driving form that assigns a journal entry that records a transaction. Then the last resort for QuickBooks to use is a journal entry, which uses debits and credits. So everything in the system is a journal entry, but it's driven by forms. The idea of it being that the forms will be easier to figure out, easier for us as users to deal with. So if we don't know the debits and credits, we can typically get away with most everything, a lot of stuff, by just using forms. But if we know the debits and credits and how they work, it's, we're probably better off in some degree. So okay, so here's the journal entry. So there's that, and it put the other side again to opening balance equity. So okay, so let's check that out. So I'm going to close this out. I'm going to close this out. I'm going to close this out. We're back here. Let's go back to the opening balance equity. This is where it said it put the other side. Let's zoom in on that. I'm going to double click on that. Say, what did it do? What did QuickBooks do? I'm going to make this 2018 so we can see the data. And there's the 75,000 there. So it did put it to opening balance equity. It increased, what did we look at? Furniture and equipment, and it put the other side to opening balance equity. Again, that's okay, but we're going to have to do something with this account just because it's kind of a weird account. QuickBooks put it in kind of a weird account. That's okay. So we're going to close this out, and that's the furniture and equipment. The accounts payable is there. We've got the Visa. That's another thing we added here. So let's double click on the Visa account. It's a liability. That's what we would expect. It's in the current liabilities. Here, it's also in a subcategory of credit cards. So, okay, that's not usually on financial statements. We wouldn't usually have a subcategory of credit cards, but that's how QuickBooks works. That's how QuickBooks rolls, how it sets up the system. So that's okay. So we're going to double click on the 1000. And we'll change the date once again to 2018. And there it is. So once again, it put the other side to opening balance equity. If we double click on it, we'll say, okay, what did it do? It's got this credit card purchase charge. Why? I've never seen this form before. How did that? I didn't put a 1000 into the. So this is the driving form that QuickBooks uses for basically credit card charges. So QuickBooks says you entered something as a liability to credit charge by putting it into the opening balance. We then will create this form because that's the form that typically would be used to do so. And then it put the other side to this opening balance equity account in this form. So this form means that credit card account goes up and the other side going to this account opening balance equity. So I'll close this out. Close this out. Let's go to opening balance equity one more time. I'm going to open this up, double click. We're going to go to 2018, see the data. It's like, yep, there's the other side. There's the credit card. So that makes sense. We know what happened. So I'm going to close this back out. Next thing, we got that one. And then we had this loan. We put the loan on the books. So let's double click on the loan. We had to put that on the books. It looks good. It's in long-term liabilities. That's what we'd expect. We do owe the bank $22,000. So we're going to say, okay, that's what we wanted to do. Let's double click on it. And let's change the date once again, 2018. There it is. Let's double click on that and zoom into it. And it made a journal entry. So put it into the register. So if I double click on this item, we'll see the journal entry. If we double click right there, okay, and then I'm going to close this, and we're going to say, well, why did it do a journal entry? Because the loans aren't something we take out every day. We don't take out a loan from the bank every day. So again, there's no form that drives that transaction. So if there's no form, the last resort is a journal entry. So this is something that QuickBooks can't really give us a kind of easy input screen to fix it, to enter the data. So it has to go to debits and credits. Remember that everything is debits and credits, but QuickBooks will try to drive things by using other means. Even this, I'm going to close this back out. It defaulted by going to a register, an attempt to use something that doesn't use debits and credits. So even this, QuickBooks is trying to avoid debits and credits in an attempt to make it easier for us to work without needing to know debits and credits. But we need to know the double entry accounting system in some way because that'll help us to kind of enter the data. So if I close this out and close this out, the other side then, it had to do something somewhere else. Where did it do something? It did something here to opening balance equity. If we double click on it and we change the date, we see that we have the 22 on the loan. So there's the other side of it. So we can see the two sides that QuickBooks did something to each side every time. So I'm going to close this back out once again. We'll close this. So now we can see that QuickBooks is allowing us to enter these beginning balances by just entering the beginning balances into these account balances, and that's great. However, QuickBooks is having to force something in some other way. These two it put on the income statement as uncategorized income and uncategorized expenses, and then into the balance sheet here as basically net income rolled into owner's equity. And because note, if I change the date up here to 12/31/18, we'll see that this is now called net income, not capital, because it basically put it into net income, which would roll into the equity section as net income. If we change the date to 2001/9, then it rolls it into equity, because net income would now be equity as of the beginning. It'd be in owner's equity because it's a sole proprietor. If it was a corporation, it would roll into retained earnings. So that's what we have here. Now we've got the opening balance because these are balance sheet accounts. It didn't know what to do with it. When we take out a loan, in other words, the other side isn't usually an income statement account. So it couldn't put it to income or expense. That wouldn't make sense. So it's basically saying, hey, we had to put this into equity somewhere. We want to tell you that we put it into equity because we didn't know where else to put it. We put it then into this new account called opening balance equity. Now, as long as we get all the other accounts right, in other words, like if every asset account is correct and every liability account is correct, then the equity is what needs to be the difference, and it should be okay. That should be fine to do that. So if everything else is correct, then you would think equity would work itself out and be okay, be correct. And that's the assumption that we are making here. So what we're going to do later then, next time, is just adjust this, because we don't want to present reports with a balance and opening balance equity. Anybody that knows QuickBooks and understands, what opening balance equity is, will understand what happened. It probably won't be a problem, but it doesn't look nice. It looks unprofessional. It doesn't look like we cleaned it up correctly. So we don't want to print reports with opening balance equity in it. So we're going to make a journal entry to take it out of opening balance equity and put it into our main equity account, which is going to be the owner's equity. And that's what we'll do next time. For more accounting information and accounting courses, visit our website at accountinginstruction.info.